In 1637, tulips sold by weight in units called aces, equivalent to about 1/20th of a gram, cost more than houses and destroyed fortunes. Today, the Netherlands exports 2 billion bulbs annually. History's greatest financial mania centered on Dutch tulips, yet 4 centuries later, tulips remain the Netherlands' most iconic export, proving the Dutch transformed their most catastrophic economic disaster into their greatest commercial triumph. The Dutch Republic of the early 17th century was experiencing what historians call its golden age, a period of unprecedented wealth and cultural flourishing. Dutch dominance in global trade, particularly through the Dutch East India Company, had made the Netherlands the economic powerhouse of Europe. By the 1630s, Amsterdam functioned as the continent's financial center, with sophisticated banking systems and a merchant seeking investment opportunities. Into this environment of surplus wealth and appetite for luxury arrived the tulip. Introduced from the Ottoman Empire in the 1590s by botanist Carolus Clusius, tulips represented exotic Eastern sophistication. The flowers became immediate status symbols among the Dutch elite, who competed to display the most spectacular varieties in their gardens. Unlike other luxury goods, tulips could be grown domestically, allowing wealthy merchants to cultivate their own living emblems of prosperity. The timing was critical. The Dutch had recently won independence from Spain and were constructing new homes and gardens on reclaimed land. Horticulture became a national obsession, with gardening manuals circulating widely and botanical knowledge considered a mark of refinement. What made certain tulips extraordinarily valuable was not human artistry, but viral infection. The most prized tulips displayed dramatic color breaks, vivid flames and feathers of contrasting hues against a base color. Unknown to Dutch traders, these patterns resulted from the tulip breaking virus, spread by aphids. The virus created random, unpredictable patterns, meaning that even bulbs from the same parent plant could produce wildly different flowers. This biological lottery created genuine scarcity. The most famous variety, Semper Augustus, featured dramatic red and white flames and could not be reliably reproduced. Growers could propagate valuable varieties only through offsets, small bulbs that formed around the mother bulb, a slow process that might yield only 2 or 3 new bulbs per year. From seed to flowering bulb required 7 years, creating a fundamental supply constraint that no amount of capital could immediately overcome. The transformation from tulip appreciation to tulip mania occurred when trading shifted from physical bulbs to promissory notes. Tulip bulbs can only be safely removed from the ground and replanted in late summer and fall. Yet demand for tulips extended year-round. Traders developed a solution. They would buy and sell claims to bulbs still in the ground, or even to bulbs not yet grown, creating one of history's first futures markets. These futures contracts initially served legitimate purposes. A grower could sell future bulbs to secure capital for current operations, while buyers could lock in prices for desired varieties. However, the system quickly evolved beyond hedging into pure speculation. Traders began buying and selling these contracts repeatedly, with neither party intending to actually deliver or receive bulbs. By 1636, much of the tulip trade consisted of what contemporaries called wind trade. Buyers purchased promises of bulbs that existed only on paper, then sold those promises to other speculators, who sold them again. The actual tulips, if they existed at all, remained in the ground while claims to them circulated at dizzying speeds. One could theoretically buy and sell the same future bulb 10 times in a single day without ever seeing a flower. In the autumn of 1636, tulip prices began their meteoric ascent. Common varieties that had sold for modest sums suddenly commanded 10 or 20 times their previous prices. By January 1637, the speculation had reached fever pitch. A single bulb of the Semper Augustus variety was sold for 6,000 guilders, equivalent to approximately 10 years' wages for a skilled craftsman or enough to purchase a substantial house in Amsterdam's best neighborhood. The speculation became self-reinforcing. Rising prices attracted new buyers, whose purchases drove prices higher, attracting yet more buyers. What made the price increases particularly irrational was that they bore no relationship to the flower's utility or beauty. A Semper Augustus bulb purchased for 6,000 guilders would produce exactly the same flower as an identical bulb purchased years earlier for 1,000 guilders. Buyers weren't purchasing superior blooms. They were purchasing the expectation that someone else would pay even more tomorrow. The market had completely divorced price from underlying value. The tulip market initially attracted wealthy collectors who genuinely appreciated the flower's aesthetic qualities. Wealthy merchants, physicians, and government officials maintained extensive tulip collections and paid substantial sums for rare varieties. However, as prices soared and stories of overnight fortunes circulated, participation broadened dramatically. By late 1636, tulip speculation had penetrated deep into Dutch society. Weavers, carpenters, shopkeepers, and small merchants, people with modest incomes and little investment experience, began trading tulip futures. Contemporary pamphlets describe scenes in taverns where working people gathered in informal colleges to buy and sell bulbs they would never plant, using money they often didn't possess. The democratization of speculation proved crucial to the mania's intensity. Unlike restricted trading in stocks or bonds, tulip futures required no special knowledge or access. Anyone could participate in tavern-based exchanges. This accessibility created the broad participation necessary for a true speculative bubble, when bricklayers and blacksmiths began mortgaging their workshops to purchase tulip futures. The market had clearly transcended its origins as a luxury trade among the elite. The tulip mania's most dangerous element was the extensive use of leverage. Few participants purchased bulbs with cash. Instead, buyers would pay a small deposit, perhaps 10 to 20% of the bulb's price, and agree to pay the balance when they took delivery. This margin system allowed speculators to control vastly more tulip value than their actual capital could support. Contemporary sources suggest many participants financed their speculation by mortgaging homes, selling possessions, or borrowing against future business earnings. The system created a precarious pyramid of debt resting on the assumption that tulip prices would continue rising indefinitely. Few participants considered what would happen if that assumption proved false. The collapse, when it came, was swift and total. In early February 1637, at a routine tulip auction in Haarlem, buyers simply failed to appear. Sellers attempting to offload bulbs at the inflated prices found no willing purchasers. Within days, the psychological shift spread throughout the Netherlands. The collective delusion that had sustained ever-rising prices evaporated. Prices didn't gradually decline, they disintegrated. Bulbs that had commanded thousands of guilders weeks earlier couldn't find buyers at any price. Speculators holding contracts for future delivery at February's peak prices faced catastrophic losses. They had promised to pay thousands of guilders for bulbs now worth a tiny fraction of that amount. Those who had sold bulbs at peak prices expected payment that buyers could no longer provide. The Dutch government faced a crisis, enforce the contracts and bankrupt much of the trading class, or void them entirely and destroy commercial trust. Their compromise was pragmatic. Contract holders could cancel their obligations by paying just 10% of the agreed price. This intervention attempted to split the losses between buyers and sellers. Modern economic historians have challenged the traditional narrative of tulip mania as an economy-destroying catastrophe. Economist Peter Garber argued that high prices for rare bulbs might have been economically rational, given their scarcity and the Dutch passion for horticulture. Historian Anne Goldgar's extensive archival research found limited evidence of widespread financial ruin, suggesting the mania affected a relatively small number of traders rather than Dutch society broadly. However, even if the macroeconomic impact was limited, tulip mania remains significant as a case study in speculative psychology. The episode demonstrates how markets can become completely detached from fundamental value when participants focus solely on price momentum. The tulip traders weren't buying flowers. They were buying the expectation of future price increases, with no logical endpoint beyond someone else's willingness to pay even more. Tulip mania has become financial culture's favorite cautionary tale, invoked whenever asset prices seem divorced from reality. Yet markets continue producing tulip-like manias. The South Sea bubble, railway mania, the 1929 stock crash, the dot-com boom, and the 2008 housing crisis all share tulip mania's fundamental dynamics of speculation, leverage, and collective delusion. Perhaps tulip mania's greatest lesson is that rationality operates at individual rather than collective levels. Each tulip trader made individually rational decisions. If you believe prices will continue rising, buying tulips makes sense. The irrationality emerged from the collective outcome of those individual rational choices, a market structure that couldn't sustain itself but persisted because each participant believed they would exit before the collapse.